All right, welcome everybody here today. You all hopefully know why you're here. We're going to talk money, capital, investment, all those kind of things. I'm going to do a very quick introduction to our guests today, and then I'll do a quick introduction to myself because I'm going to let them tell everybody who they are. In reverse order, far order there, we've got Marcus Shaw, Andrew Daniels next to him, and then Rob McClay here as well. So what I might do is hand over to these guys to let them explain who the hell they are and what they're doing here. So we might start with Marcus.
Yeah, right. Welcome everyone. Hello. Marcus Shaw is my name. I'm from Scott Pack Business Finance. So we specialise in invoice financing, trade finance, and also asset finance. Prior to that, I've been with the Commonwealth Bank for about 10 years, where I was in corporate banking, and then prior to that, I was in accounting firms, various accounting firms, EY, etc. So that's sort of my background.
Cool.
Here today to answer any questions, and hopefully I can add some value.
Andrew?
Yeah, Andrew Daniels from Moralis Advisory. In short, we help businesses get fit and get funded, but long complicated version is we just help people on their journey, helping them to get strategically and financially hit their potential. So background in corporate restructuring and in finance. So I'd like to think, hopefully I can answer a couple of questions today, so far away.
And the soon-to-be Dr. Rob.
Yeah, my name's Rob McClay, and I guess I'm the odd one out here in that I founded a business, DoseMe. We raised several million US from family offices, high net worths and the like, prior to the eventual acquisition of DoseMe by a listed company. So I was in the position where, having raised the money, I had to figure out what to do with it. So kind of opposite side of the table, but happy to take any questions on that.
I think it's a good mix because we've got the corporate side of things, or two lots of the corporate side of things, but a lot of what Andrew deals with is down at the other end, the smaller side of the business, and as Rob said, he's had experience with investment and spending other people's money, which must be quite enjoyable. Is it scary processes?
I think scary is probably the best description. Although it is quite funny when you're encouraged to spend the money faster, which I think often for early stage businesses is something they need to be pushed to do.
Cool. My name's Simon Dell. I work for a company called SEMO, is my company. I'm the CEO. We are a marketing staff on demand, so not really in finance, but I've known these three gentlemen very various kind of channels and over the time. So we thought we'd try and put this together because finance, investment, money, cash flow is something that is a huge challenge to a lot of businesses. And if we can get some advice from these guys and share it with you guys today and share it with the people watching this video as well, and then hopefully people can take some value out of that. So we're going to run through some questions. There's sort of 5 key discussion points for today, and then we'll open it up here to anybody else for their feedback. We might start with Andrew. We want to talk about where you actually get money from, because there's a lot of different avenues that you can potentially get money for your business.
Yeah, absolutely. So, the obvious sort of ones is people think of as a bank. I like to think of them as probably one of the last people you go to, but people start with themselves, friends, family. You look at private investors, venture capitalists. People often don't think of it, but like retailers. So if you go to your Optus provider or your Harvey Norman or whatever it is to get your office furniture, to get things set up, you can use that as a form of finance as well. But the biggest one that we've been using lately has been with one of the businesses I was involved in, was using suppliers and customers to actually help fund your business as well. They're actually surprisingly, because they get it, they understand, they're invested in the process. So I launched a business with some friends of mine, very small investment, probably about 25 grand all up. And we just all put in a little bit of money, and we used one of our main suppliers to help finance us. And we got in 6 months from literally a great idea, terrible execution, up to 800K turnover. And it was just funded through that by using those suppliers, using our customers to help us to get, to fund us through that process. So they are a really useful source, and people often forget about that. Another big one that people forget about too, particularly in the smaller side, because there is some work involved, is government funding. So the government, through whether it be R&D grants, whether it be innovation grants, whether it be through employment, so as in if you can employ someone into your business, the government is willing to provide you some assistance in that regard too. So there's a couple of different ways you can go about it. I think this morning I wrote them all down. There's about 13, so crowdfunding, private lending, bank funding, factoring, just to name a few. So if you've got time, make sure you think about all the different ways you can find some funding.
Talk to me about the conversation that you have with the supplier, how that goes. Are you kind of saying to them, we want you to supply us with services and we're not going to pay you for X amount of time, or we're just not going to pay you at all? Or how's that conversation happening?
That was an awesome conversation to have where we sat down and said, look, you're really big and you've got deep pockets. They were a nationwide retailer, and we just said, look, we just simply don't have the working capital to be able to fund it, to grow it as much as we want. And they just said, look, we really appreciate your honesty.
Yeah.
That was the biggest thing. We were so concerned about saying it and embarrassing ourselves. And they said, of course you can't scale up to nationwide overnight. That's just, let's be honest, that's just not how it's going to work. So we went down and we sat them and said, look, this is the process we're going to pay. This is our working capital cycle. This is how we're going to get it to work. And we're going to need to continue to reinvest to get the systems and processes right. Can we go to this type of an account? And they just sat down and said, yeah, look, you've actually shown that you're across it and you know how this is going to work. We're happy to,
right.
Because we're getting a benefit out of it.
Yeah.
We're happy to play along. At one stage we said, would you like to come in as an investor? And they just said, look, we get that, we want you to have your expertise. You run your race. We'll sit back on the side and we'll support you along the journey. Because the more we get out of it, the more you get out of it, the more we get out of it.
Give us an idea of you don't have to give us all the detail if you don't want to, but give us ideas of the terms that you actually sort of struck up with them. Was that, was it 60 days, 90? How was that? Or is that sensitive information?
It was not sensitive information.
Okay.
The terms were, we'll pay you when we can.
Right, okay.
And they just said, fair enough.
Did you pay them?
Yeah.
Okay.
Oh yeah, we did. Yeah. Otherwise, it'd be fantastic. But essentially, we were providing their customers a service.
Yeah.
And so, as part of that, we just said to them, look, we need to pay our subcontractors, and so essentially, we would then pay our subcontractors a bit later, and subcontractors were happy with that, and we were then also paying them back our introduction fee at a later stage as well. So effectively, just using both sides of the equation to help us manage and grow.
Okay. Marcus, where do you see most of the money being sourced from?
Well, I think there's, as you've alluded to, Andrew, like a couple of ways you can get it. It depends on where you are within your business sort of cycle, I think. So as a startup business, there's how you got it, those sort of terms. You can also look at reverse factoring, which is basically getting a company like, Greenseals would be a perfect example, that they're not doing so well at the moment, but that companies such as that, that actually pay your creditor up front. So you don't have to worry about getting the terms short, that sort of thing. You can get that off the Greenseals will pay for that. Private equity is another good one, particularly for startups. They can often be a help, or investors too, looking at coming in and investing capital within your idea, your business, to take some shares that can help you sort of, move along a little bit quicker. Another thing to look at too is if you're buying a new business, for example, wanting to maybe acquire something, is looking at tangible assets within an existing business. So you can capital raise against tangible assets within the business to get some money to put back in to maybe acquire that new business, or even an existing business you want to grow yourself and you've got assets within that you can utilise to capital raise against to grow.
So essentially you're borrowing against assets that you don't even own yet. Or
correct.
Yes.
Well, for a purchase.
Yes, for a purchase.
If it's a business that you own and you already own the assets, you can get them valued and then capital raise against those existing assets. They've got to be tangible.
Well, I was going to say, what sort of assets?
Well, again, it depends on the style of business. So, say if it's manufacturing, you'd have a lot of like manufacturing equipment, things like that. You could capital raise against that. Any sort of P&E, property, plant equipment, that sort of thing. If it's a services business, there's not really anything tangible there.
Okay.
And anything intellectual property. That's intangible, so you can't really capital raise against that. It's something that you could sell as goodwill in the future, but you can't capital raise against that now.
Okay.
So they're probably a couple of ideas. Other things was mentioned factoring. I suppose that's a good one. If you're already established, you've got terms that you've got for customers to get that cash flow in quicker. But
Explain
need
for
working capital.
the sort of uneducated,
Initiated.
those people who've uninitiated with invoice factoring. Because I always my sort of my understanding is perhaps a little bit blurred in that because I've not ever done that before. But
Yeah.
are you losing an element of that money or?
Well, everything comes at a cost. So it's really instead of doing an overdraft, it's utilising your debtors.
Okay.
If you've got longer term for those debtors, it's getting the money within 24 hours. So you don't have to wait 30, 60, 90 days, whatever it may be.
Yeah.
You can get that money within 24 hours, usually 80% of the invoice amount. And then you'll pay a fee, depends on the business and the amount that you've got lent out. But, anywhere from about 0.5 to 1% of that invoice cost as a total cost.
Okay.
And then you get the 20% back
When the actual
when the
invoice is
customer
paid.
has paid their bill.
Okay.
So that's a good way you can utilise it to say pay creditors quicker, or you might put staff on or buy some assets or things like that, just to get that money in quicker. You've got to remember though that you still need enough for your working capital cycle. So you don't want to just go, I've got all this money, I'm going to go out and buy a brand new Porsche. It's got to be like, okay, you've got to use. If you use it sensibly, it's fantastic. Yeah.
From an
It's all
invoice
about that.
factoring perspective, are they what are the conditions of the invoice? Because obviously you're not going to buy any. They're not going to buy any invoice.
Well, generally it depends on the company. I suppose will depend on or the industry. So within debtor financing, it's really related to the debt or the security is that invoice.
Yeah.
So it's got to be factorable. It's got to be someone that's I suppose been around a long time because that's the security. So, but we're not taking houses or anything like a traditional bank would. It's the invoices, so it's important that it's signed off.
Yeah.
You've it's deliverable, things like that. Some companies do take insurance, debtor insurance over those debtors, so that if there is any issues, they'll get the money back up to 95%.
Yeah.
ScotPac doesn't do that, but it's really the industry too.
Okay.
So it's.
Are there certain industries that are better?
Yeah, certain industries it just doesn't suit.
Okay.
So, but other industries like manufacturing would be a good example. Recruitment, labour hire, that sort of stuff.
Yeah.
Transport, those sort of companies where they've they deliver a service and then you get paid for it. Yeah.
Rob, how many raises did DoseMe go through?
So we had our initial seed raise of about $500,000.
Yeah.
We then did a Series A of, I think, 3.4.
Okay.
And we then did a bridge round later.
Right.
And then during the acquisition process, we had a convertible note as well, essentially to lock both parties into the deal. So we actually used, I guess, a couple of different ways of raising. Yeah.
I was going to say, we'll talk about convertible notes in a minute because you've explained this to me before and I'd end up explaining it to other people as well. So I thank you for that education. The seed round. So, there might be people here early on in their business journey or even, down the road where they're looking at potentially raising money for the first time. Define what a seed round is and how did you go and get money in that, in that round?
So a seed round is a little bit hard to define in the sense that for seed rounds, people seem to take anywhere between, at the very, very low end, 250,000 up to, I think the largest I've seen in Australia would be near 10 to 15 million, which is very, very big for a seed round.
Yeah.
But I guess the essential definition is that it's kind of all in the name, right?
Yeah.
It's the money that you take to let your seed sprout and start to grow. So typically it's assumed that if you're going to go into ask someone for a seed round, you've got something there to begin with. So you've got the at least beginnings of your minimum viable product, and you've got a team and you've got a defined market opportunity.
Is that what you had at that point?
Yeah, that's what we had at that point. So to explain, DoseMe was a software-based medical device that calculated a dose of medication for an individual patient based upon their lab results. At the time we did the seed round, we had working software, admittedly a bit rough, but still working, that could calculate the dose correctly. But medical devices need to be registered and cleared or approved by regulatory bodies, and we didn't have that.
Okay.
So we needed to take funding to take essentially a prototype, if you will, to a product that was legally able to be sold, and then build the sales and marketing infrastructure around it.
How were you, before you went to the seed round, how were you was this sort of you working at home on your own building this, or?
Yeah, so it was myself and another colleague from UQ. Right. And essentially we dipped into our own bank accounts to the tune of somewhere around the $50,000 mark each, I guess. And then in addition to that, of course, I wasn't drawing a salary at the time. So I lived off the generosity of my wife, as she would probably put it. I mean, that kind of is the classic early startup.
And I guess that's the challenge with all startups, and you guys must see it as well, is that somewhere along the line there has to be, well, there doesn't have to be, but there is often an element of pain in that early stage where potentially one of a couple is living off the other one. And I had a mentoring thing the other week where the guy was trying to build this massive big business as a side hustle, and he didn't want to give up his main job because it paid so well. You must see those happen all the time. As now an investor, as now you being at the other side of the deal, do you look for people who've gone through that pain?
Ideally, I look for people who are clever enough to have been able to avoid it in some way. And what I mean by that is that the DoseMe as a business was good in that it was very defensible. It took so much effort to get it to market, and there were so many regulatory hoops that in the end we only ever had one real competitor, and it took them so long to get to market that we had a lead. A better business, though, is one, of course, where you don't need to jump through that and you can turn on the revenue taps almost straight away. Yeah. And I think what we've heard from Andrew and Marcus is some of the other options for funding. And one of the ones that I think is easily the simplest, if you can negotiate with your customers to do it, is simply to be paid annually in advance. If you're selling a service to them and you fit into that category, and you can charge them up front, you'd be surprised how many big businesses actually prefer the simplicity of only having to go through procurement once a year. So that's a kind of dead simple way of, I guess, almost DIY factoring in one sense, that is really, really attractive for an early stage business. And if a business can do that, then it demonstrates to people who are investing that they've got product market fit to an extent where their customers are willing to take a punt on them as well, right? Because if you're going to pay a new startup 12 months in advance for a service they haven't delivered yet, they're good at selling, right? And that's a pretty good sign.
A big box to tick.
Yeah.
Once you've got the money, where did you spend it?
Yeah. So I guess I made the classic mistake of putting too much into development and not enough into sales and marketing. We still put a significant amount into sales and marketing, but now I guess that I'm kind of coming at it from the other side and seeing lots of different startups and working with a few of them. The only reason you take money is to grow your company's net worth. And the only way you can grow your company's net worth is by increasing your revenue or by selling more. And we were talking about this a little bit beforehand, that the way to, I guess, make money is to concentrate on one thing and do it really, really well. That's why you're being given money. It's so that you can concentrate your business on that one thing and do it well. That doesn't mean that you go and build the next thing or make it bigger. If you've already found product market fit in one area, you should be figuring out how to tell more people about it and how to sell that to more people. And by doing so, you'll then increase your revenue, you'll increase your value as a business, and you'll either not need to raise again or you'll make it much, much easier too.
Andrew, where do you see people investing money that they raise?
It's actually funny you talk about the R&D side. I helped a business in Perth recently, software. They'd been given the seed round, they had the money, and they just went hell for leather on R&D. And completely understand that you need to have people assume you need to have a bulletproof product to put to market.
Well, I really disagree with that, actually.
Well, that was the thinking.
Yeah.
But you're absolutely right. It was this thing of saying, well, it needs to be perfect, and that way word of mouth will just flow. And I went, well, no. You need to be able to, we just did some projections, because I came into it probably 3/4 of the way through his R&D cycle, and I came to him and said, you're going to need to go back to your investors and ask for more money. And he said, yep. And I said, so far you have not executed on delivering them a return or the prospect of a return. And he just looked at me and he goes, no, but I'm so close to getting my product good. And I said, they don't care about that. And it was this horrible conversation to say, people actually aren't interested in you getting a perfect product. People are interested in a business. They want a return on their money. Let's put a plan in place to get you customers. Let's get your plan in place to actually start you making some money. And it might not be the absolute perfect, deluxe version that you're looking for. We need a part 1, let's get some dollars in the door. A part 2, this is what it can look like once we start to get that cash flow happening. And then part 3 is down the line where we can start to get that happening. And we actually started to end up using the process we went through. We said, we're not going to be able to hit up our investors for more money. We're going to need to go out and ask our customers, can we get on a monthly retainer to get this product in place for you? Can you pay up front? And customers are just like, oh, this is perfect.
I could not agree more. Being in healthcare and having to use the software that's available in healthcare really puts it into perspective. The fact is, all electronic health records suck. They are some of the worst software you could ever possibly use in your life. But they're sold for billions of dollars because they're better than the alternative and they save money. And when it comes to developing software or really any product, you just need to ask yourself, does this deliver a benefit to the people? Does it make their lives easier? If so, the fact that it's maybe a little bit ugly might make your sales guy a little bit more uncomfortable when he's selling, but it won't stop him getting the deal.
Because on that, I was going to say, who's deciding that product if it's perfect or not?
Yeah.
And it's generally the customer.
Yeah.
So you need to get it out to them and then let them give you the feedback, and then you can develop further from that.
It's the classic ugly, it's called the ugly baby syndrome, is that, you always think your baby is absolutely perfect. And be it a human baby or a business, your guy in Perth is probably terrified of going out there and suddenly people saying, no, I don't like it, I don't want to use it.
Yeah.
Because he's so convinced that his baby is perfect.
Yeah.
And one of the things early stage in business is accept that you have an ugly baby. And the best way of improving the ugly baby is to give it to the customers, as you say, and let them give you feedback and accept that 19 out of 20 people are not going to like your baby. Yeah. And one possibly is. And once you understand who that one is, then that gives you, more options to...
Oh, absolutely. And sometimes it's just a matter of actually getting your product in front of more people. And then people then can say, actually, you're pushing this, but this is actually your secret sauce. This is actually the thing that can go ahead. Yeah, this stuff is, a nice to have, but this is actually where you should be focusing your energy. This is what's your key differentiation. And just simply getting that feedback from people and getting in front of more and more people. Yeah, I know everyone's got this thing of, I don't want to release my secret to the universe, but as I'm sure it was the case for you, it's like, well, it's taken me 3 years or whatever it is to get to the point where I've got these boxes ticked. Who else is going to invest their money and go through this process overnight to be able to catch me? Probably not many people are willing to do that to themselves, right?
No. And you're dead on with what actually values to the customer may not be what you think that is. And as a classic example in DoseMe, if we sell that into a kind of medium to large hospital, on average they'll get the last time I did the figures on this, a bit over $4 million a year in savings. The thing is, the bit that they actually care about is about $100,000 worth of that, because it's attributed directly to one budget. And it's not decreasing hospital length of stay, which DoseMe does, or decreasing adverse events. It's the fact they need to order less tests, right? And they need to repeat less work. And when it came to us selling, that was actually the immediate yes, we're going to buy it trigger when we were going through, the benefits of the solution. And I think you find that in just about everything you do. The customers will say, yes, I really like that about everything else you're saying, but for me, this is the problem that my boss is complaining about at the moment.
Yeah, so it's understanding what your customer, their needs are.
Yeah.
And you can't do that without sort of speaking to your customers and getting feedback from what they need.
Yeah.
Yeah.
So, and then you develop it around that as opposed to like putting out what you think's right for them.
Let me ask you the reverse question, Marcus, before we move on. Is there anything that you would caution people to not spend investment money on?
Well, it really depends what stage of the business you're at and what you're wanting to. I think a classic example would be putting too much into R&D,
Yeah.
and not getting a product out to the market. Like, again, it depends on what type of business you're in and what your end goal is. So really understanding your business is really important and what you want to get out of it.
Yeah.
Don't worry too much about all the peripherals. Worry about what your business is, the core of your business, and then take it from there, I suppose. Like,
Do you think it's the sort of added on question to that? Do you think it's more important that the business shows sustainable growth in the early stage? And I keep saying early stage, but you guys might have businesses that might be 2, 3, 4 years, even longer old. Do you think it's better that you show that the business has sustainable growth, or that it can make a profit, or both?
I think probably sustainable growth is important to start with, because profit will come. Well, you're going to get profit anyway for sustainable growth, really. But long term is what you're looking for is growth. Well, with sustainable growth, profit will come long term anyway.
Yeah.
So I think focusing on that, focusing on your customers, focusing on the core of your business and what it really is about, that'll get you to the end point anyway.
So, Rob, on that, to ask you that question, when you look at a business, do you want to see it improving every month? I mean, if it was static for 12 months, is that a warning flag for you?
Yeah, I would really want to know why. Admittedly, I'm very much, when it comes to the investing side of things, I'm in the startup space. So you're after rapid growth.
Yeah.
You care about unit economics as well, because that's the sustainable part in sustainable growth. And an example of a case where there was really good growth but it fell over would be Shoes of Prey. So Shoes of Prey was custom design your own shoes online, and they simply couldn't get the product made cheaply enough to go to the mass market. They kept having good growth, but ultimately it wasn't sustainable. So you do need to know what the cost of goods sold is when you're looking at a business, but you do want that continual growth. If there's not continual growth and it's not, Commonwealth Bank or a similar large mature business, that kind of is a red flag. Has something changed in the environment that means it's no longer working? Has something changed inside the team? Yeah. So that, yes, you would have concerns around that.
And if it wasn't showing profit, I mean, Marcus made the point that, profit can come later on. Obviously, what you see with all these big stories about, the Airbnbs and the Ubers of this world is that they're, losing money and losing money and losing money with the eventual, eventually they'll be making money in the future. And I think if you look at Amazon, the Amazon story in the late 90s when they were losing money hand over fist and, and now, they're printing the stuff.
Yeah.
Is it okay to go, profit, we'll worry about profit later on. We're just going to take every dollar that we make and reinvest it?
Well, it depends on how much money you've got to sustain yourself. You can't be non-profitable forever. We're all in business to make money. So, but I just think that depending, like a lot of businesses can be cyclic too. So 1 month you might have a bad month, the next month you're making hand over fist. So you've got to understand that part of your business so that you're keeping money for your working cash flow cycle.
I'm not sure that DoseMe ever sold a single service in December, for example.
Yeah,
right.
That would be an example of a cyclical, impact on businesses. I think it's important in this discussion to separate out revenue from profit, though. You need to be continually growing your revenue. If you're still not profitable, but you're maintaining a similar margin because you're putting all of your funds and then some into growth, that would be fine.
Okay.
If
It's
As your
understanding what's
revenue
causing that loss.
grows,
Yeah.
your gap between profitability and revenue continues to grow, then that's a red flag,
Mm.
right?
It's simply a case of just stepping back and saying, what is driving that loss? You know, if it's a reinvestment, you know, it's sort of, if there is a whole bunch of one-off expenses or it's just flooding marketing or whatever it might be, then you might look at it and say, well, it makes sense. Every dollar that they get in, they're pumping in, you know, they've been living on baked beans and 2-minute noodles for 5 years, but they get it that it's all about that growth. Because no investor is coming along thinking, this is maxed out as far as its earning potential. People are coming to invest in because they're investing about what the next couple of years are going to provide for them.
Yeah.
So they are always thinking, I can get this a better return out of this than the people currently running it. So to me, it's not about chasing that perfect margin and just delivering on that. It's about saying, okay, what can we set this up for someone down the track? And most of the time, it's through that large growth that gets people excited.
Because the reality is, any investor, you know, aside from if you're doing the invoice factoring things, but any investor is in it because they want to make money.
Yeah.
I mean, there might be some, you know, altruistic kind of, you know, mission behind it, but most investors are there because they want to put $100,000 in and then take $300,000 out a few years later.
Well, with the invoice financing piece, that's not really going to help that's going to help a business with their working cash flow cycle. But from an investment perspective, that's not really going to, you know, an investor they don't care about that. That's just, you know, other money into the business. It's more sustainable growth, long-term return on investment. That's what they're really looking at the end of the day.
But, you know, don't sell yourself short. To me, using factoring is, you know, you have X dollars. Say you have 100 grand. You then say, what is the best use of those funds as an investor? You know, it might be this particular product, or, you know, say it's a car. You know, we could put 100 grand cash into that car and use that to run around. Or you say, well, actually, we're better off financing that and putting the, you know, 90 grand towards something else instead. You know, to me, it's about thinking about where do you allocate those dollars to get the best return. And most of the time, whenever I was dealing with a company who was just recently got a large investor in, the first thing the investor does, go out and say, how can I source as much debt as I can to get a better return on investment? So, you know, it is a very useful thing to make sure you can have a relationship, even if it's a small relationship, starting to tick away with a financier.
Yeah, I think it's important too to consider that you've actually got two things that you're investing money in almost. You've got your product, which solves the problem, but you've also got the business itself. And in the, you know, if you do move to the point where you're being acquired, you're selling the business just, you know, actually to a greater extent than you are selling the thing you've built to whoever's buying you. So if you go through a due diligence process at the end when you're selling your business, you'll probably spend 3 times as much time on the business itself as you will on the product or the item that you're manufacturing. So, you know, thinking about all avenues for gaining extra funding for your business as well as, you know, your product, it's definitely worth considering, you know, other revenue sources such as factoring or grants or co-matched investment from government funds, as difficult as they can be at times. You know, there's a whole range of different things out there that you should consider.
I just think using it for the right reasons would probably be my point. Like if you get that money in quicker, like I said before, don't go and buy a, you know, brand new car or something that's not going to add value to your business long term. Is probably my point. Like it's definitely going to help. But
so there's two things that I was just going to add on to that is, one is I was helping a restaurant recently. They're really good at what they do, and they wanted to invest, and they said, we're going to go and buy the shop that we're currently leasing. And I said, okay, how much are you going to have to put in? 50%? That's going to be for the particular place they're looking at. It was like 1.5 they're going to have to invest to purchase it. I said, the return you get on that 1.5 is probably going to be about 11% by the time you use debt to help you fund that. How much would you get on a return of 1.5 if you went and opened up a couple of new shops around the place? And they looked and they just went, okay, I now actually understand what business I am. Yes, it's important for me to have a place, but if you sign up a 5-year lease, you can still, everything is just getting expensed over that period of time. The other part that sort of touched on there is there's 2 storytelling that goes on. One is the storytelling for your product, and the other is the storytelling for your business. And so you've got to remember who you're talking to and what story you need to be telling. So you need to plan out how to sell the story to customers about what your product offers, what the benefits are to them. But the other side of it, which is probably the neglected side, is about that storytelling piece about trying to get investors or people involved in your business. And this is something that I saw a lot of in banking days, where people would come in and say, I need 200 grand. And you say, what for? Can you show me the use for that fund? Where is that going to be allocated? What can we actually get out of that? And people would just forget that we do, bankers, broadly speaking, aren't across the intricate details of your business. They don't know what's happening for you. You need to explain that. And same again for investors. You need to be able to tell that story about, this is the path we're going on, this is what your dollars are going to get, and this is how we're going to implement it to go forward. And the ones who really understand selling that side of the business are the ones that do get funded and do get those opportunities.
I mean, it's the classic mistake when people are making a pitch deck. They focus too much on the product and less about the opportunity and what they're going to do with the funds. The product piece in a pitch deck is really only there to say, I have an interesting problem and I can address it, right? The bits that your investor is going to care about are, is the opportunity big enough? Is there a sensible strategy to get there? And is the team likely to actually be able to pull it off? It's the latter bits that are the really crucial parts.
On all that, then, how do you measure those outcomes? Obviously, Rob, from your perspective, you were sitting down having board meetings and you obviously had Stephen Baxter invest in your business at one point. And how do they measure their success? I mean, they put a certain amount of money in. Are they sitting there with a calculator working out the value of the business every time they sort of sit down with you?
Only when you do rounds. So when you raise more money, then you have a event that allows you to calculate what's happened to the amount of funds people put in a business. That should be going up, not down. But it will go up, kind of in uneven increments, depending on how much you're raising and the purposes for which you're raising. I guess the truism for startups is that cash is king, and if you can't show that you're bringing more cash in the door, as opposed to amortized or other accounting strategies, if cash flow comes first, and then beyond that comes user number, right? And the reason why user number or customers that you've sold to is important is that in the early stage, and certainly like we and most companies do, you're willing to take a bit of a haircut on the price that you're selling for to get market share. So, cash and market share.
Anything to add to that, Marcus, in terms of adding how you measure those investments?
From an investor perspective?
Yeah.
Well, I suppose they're really looking for, it depends on what they're wanting, again, to get out of their investment. It may be a percentage-wise growth on what they put in. It may be looking for equity growth in the business. Like it's a little bit sort of open-ended, I suppose, from that perspective. But I think what you've sort of alluded to is really the main sort of couple of points there.
And Andrew, I guess if you want to take this investment seriously, or you want to bring money into the business anyway, the owners of businesses should really have their head around, their zero account, their P&L, those kind of things. Do you find a lot of businesses, and I know I have, and I'm not a finance guy, and I've taught people how to read a P&L. Do you see a lot of businesses out there that struggle understanding their own numbers?
Oh, I'd say way too many for my liking.
Yeah.
And I think that's probably the biggest challenge sometimes is that people I've seen people who say we haven't looked at our books for 6 months, and I just think that's obviously not ideal. People, I spoke to a business only the other day, 10 mil turnover, and I said, how's things tracking? Do you know your pricing? Do you know what margins you're making? He goes, we've got cash in the bank, so things are going well. And I'm just like, that's amazing. But once you start to break down and say, well, what is actually making you money, what's not making you money, we can drop these 2 product lines and your profitability shoots through the roof. And they they just don't simply see that. So to me, it's knowing your numbers is the most important thing. If you're not across that, you're doing it almost for nothing. The other thing to think about too is for those investors is you need to think, what is their exit strategy? So you need to think, okay, are these people happy to say it's 3 years' time and we're going to sell it to a major retailer, we're going to sell it to the health department, we're going to sell it to whatever it might be, or are we going to set up, change the model or raise money or what's our out? And so I think once you then have that in mind, it's so much easier for you to focus on what you're doing. So you can then say, okay, for the next 3 years, we're going to tick off these following boxes. This is our capability. This is what we're doing. We're ticking these boxes off for this year, this year, this year. And next second, you know, when you focus on that, you can probably do it in 2 years instead of 3 years.
Yeah.
And it's so much clearer. And that way, then when you are selling for a multiple of revenue, you're actually across that and everyone's clear about the way out.
Yeah. Let me just talk about exit strategy with Rob. When did you sell the business?
So we had initial contact with our acquirer probably around about July, and we then had a term sheet probably by August.
Right. Okay.
And then 1st of December, I think, was signing date. And
Wow.
it then took 12 months to wrap up the sale of the business with
Okay.
various earnouts.
So that's almost 18 months.
Yeah, pretty much 18
Right.
months.
Okay. So it wasn't they didn't rock up, write you a check and you were gone.
Unfortunately not. We would have definitely have accepted big duffel bags of cash thrown in the door.
Yeah.
But ultimately, you know, it's quite an involved process where you need to, where you get examined in the most intimate of detail to make sure that you're not hiding anything under the covers, or
Yeah.
alternatively, there's nothing there.
Yeah. And I don't know whether it's, so you don't have to tell me this, I don't know whether it's a matter of public record, because I'm sure I did see it in the news somewhere, but how much did the business actually sell for?
Yeah, so converted into Australian dollars, and again, because it drops in several tranches, it's a little bit fuzzy, but it's
Right.
about 41.5 million
Okay.
Australian. Yeah.
Okay. So put that in perspective, that was 41.5 million Australian for how many years worth of your life?
For probably 9.5
Okay.
years.
That's pretty good.
Yeah,
I mean, obviously you
the
had
investors obviously
you
took
obviously had
the,
investors as
the
well, yeah.
majority of,
Yeah,
of
yeah.
that. But no, look, it's, you know, obviously you can do well out of startup businesses, and you know, there is a certain risk premium there for sure. But when it comes, you know, one of the bits of advice I got from Steve Baxter, who in real life is not quite as bitey as the Shark Tank persona might suggest, he was wonderfully supportive, but he said, look, the thing that you need to focus on is actually growing the business. You get the business right and the exit will take care of itself.
Yeah.
And by that, he didn't mean that you don't think about your exit, you don't think about your strategy of how you can get to a saleable place, but that first and foremost, you really have to be simply about focusing on growing that revenue. So it's not a very complicated line. There's no deep, dark secret there. But making sure that, you know, you've got a product that your customers, that you know, you're working on for solving their actual problem. That'll help you grow your revenue, and then you need to simply focus on the marketing and the sales, getting it out to as many as people as possible in a sustainable way. And then, of course, you've got all of your challenges internally, such as growing staff and so forth.
Within those 9 years, and the last question I'll ask you on this, within those 9 years, at what point did you think I have a saleable, or I potentially have a saleable business? Was that in your head sort of really early on, or was it when you suddenly had someone email you going, we're interested in buying your business?
Yeah.
Was that the first point you kind of went?
Oh, that's a bit of a hard question. Look, from the beginning, when you're doing when you're doing a business, you need to have the ability. I would put it to have confidence in yourself. My mother would probably use a different phrase to describe that personal attribute.
Yeah.
But you need to be very confident in what you're doing. So if you don't think that you're going to be able to sell it one day from the beginning, you should probably think really hard about why that is.
Yeah.
So that was always at the back of my mind. But, you know, I think it was 6 different times we were approached by people interested in buying the business. There are a lot of tire kickers out there. So until the cash is in the bank, you know, it's still not sold yet. So, yeah, I always thought it was something that one day we would be able to sell, but there's still somewhat of a surreal feeling of disbelief when finally the check does clear at the same time. Certainly when you go into due diligence, you know, things are getting real though.
Yeah. There's a discussion I've had with a lot of business owners through the mentoring I've done about every business should have an exit strategy. Even if you don't actually want to sell, you should have in the back of your mind that you're building a product to sell, and that should be a key focus. And I never forget a conversation I had with a guy who had an air conditioning company, and he was approaching retirement. He was in his early 60s, and I said to him, "Have you thought about selling this?" It was a well-established air conditioning company, and there was probably other air conditioning companies that would have bought him up and bought out his book of clients and all those kind of things. And he sort of said to me, he goes, "Well, I don't want to sell it." He goes, "It's my baby." He treated it like one of his children, and he goes, "I don't think it's worth, he goes, I think it's worth $200,000." And I kind of, that frustrates me because I've got early 60s. He's been working on this for 20 odd years, and he's got an asset that's worth $200,000. So that's frustrating as well, and I'm trying to sort of say that to him. And he gave me all these excuses about why he wouldn't sell. It was his business, and he'd grown it from scratch, and he wanted to hand it down to his daughters, and et cetera, et cetera, et cetera. And I said, "So if someone walked in here with $200,000, he goes, you wouldn't sell it?" And he went, "No, definitely not, definitely not." I said to him, "What if someone walked in here with $2 million?" Tune changed completely. He goes, "Fuck yeah, sell it in an instant." So all that kind of emotional baggage that he had attachment with this business suddenly disappeared out the window when the right amount of money was in front of him. And what he should have been doing 10 years ago, 20 years ago, is sitting there going, "How am I going to build a business that has a value of $2 million by the time I turn 65 so that I can sell it, walk away, and have a fantastic retirement?" Yeah. So just out of interest, all the business owners out there in the audience there, do all of you have an exit strategy in your head? No, there's a lot of, there's a nod there, sorry? Not defined, no. Yeah. Yeah. Yeah.
But you've sort of touched on the point. If you don't win within the mind, whether that's
Yeah.
it's very difficult.
I've
Success as you go.
in the last few months, I've met some very, very smart, very driven, motivated people who own businesses who are closing on that retirement age and have suddenly dawned on them that the business that they've spent 15, 20 years building has zero assets because everything they've done has been relationship based. Yeah. So once they come out of the business is worth next to nothing. And I think that's probably a flag. And Andrew, or Marcus, you've probably seen the same thing. Where it's relationship based businesses that have no tangible value.
Well, and I think it doesn't matter the size of the business too. Like I've worked with businesses that are multi-million-dollar turnover businesses when I was at the bank, and one of the questions I always asked was succession planning. Like, have you thought about that? Because they may have kids that just have zero interest in the business altogether. I mean, it's the father's, it's his legacy. It's the kids don't want to have anything to do with it. They're just living off the, the cash. So how do you get rid of it? So they've got to actually sort of really think about,
I think most business owners don't think of it as, for me, how I try and help clients is to say, you need to make yourself redundant in your business. And for some people, that's terrifying. It's emotional. But you say your goal is to make yourself redundant within your own business, and so that way it is actually running by itself. You know, I think we've all, through our super, have probably got shares in a whole range of different companies. We're all passive investors in that, and it's generating us a return. We need to think of how can we step back from having a job which just so happens to be working for your business, and start to think, I am now an investor in my business, how will I drive this? And that's pretty much the job that I have with a lot of clients, is just literally helping them, sounds stupid, but facilitate that conversation with themselves as a business owner.
And I think on that point too, a lot of businesses a few businesses have come across too, as vendor finance is starting to become big too. So even if they want to sell, they can still stay in the business and help someone get into it by providing some, vendor finance, some equity really. So they take a backward step and more become a consultant as opposed to the day-to-day running of it, because this new person's come in. And that's the way too, they can say, well, I'll keep 20%, you run it, and then I just sort of step back. So that's another way you could sort of think about too, from an established business to get out of it, but still have an interest.
I think if your business isn't attractive to someone else to buy, you really need to ask yourself why that would be. And for many companies, the easy answer is you're very early. It's not, big enough yet. But once you get beyond that point, and you have a solid revenue stream that's growing at whichever rate, is appropriate for your industry. If that's not attractive to someone else in your industry, at least, there's going to be a red flag there that is surely holding you back or doing some damage to your business in some other way. We've heard the big one, which is the kind of obsessed founder relying on their relationships in order to, to push the business forward.
Yeah.
That's a common issue, and as a founder, yes, it can be very hard to step back, but it is worth it. And then there are many other issues as well. So perhaps you have issues with intellectual property or with your contracts that mean that you can't sell the business out of the company or whichever mechanism you're wishing to use to exit. This comes back to, again, the business is a product too, right? So you need to spend time actually solving your business problems. And if you solve a problem that is making you less likely to be able to sell the business, odds are you're going to be able to grow it more easily and more quickly too.
We've touched a lot on cash flow and managing cash flow, but Andrew, is there any sort of other, tricks and, ideas that people should be because obviously cash is king and, some people do judge their business by how much is in the bank, but is there any other kind of ways that you encourage people to, keep more cash or hold more cash?
This is probably the most painful part of my job, is speaking to people and they simply don't know what their working capital cycle is.
Right.
And to me, that is so important, is to say, okay, exactly what does this look like? Exactly what is that dollar amount?
Yeah.
If I want to grow to the next phase, how much money is that going to be that I'm going to need to have invested? And it is mind-blowing, the sizes of the business that I see which simply don't do that. We're projecting we're going to double growth. And I said, okay, how are you going to fund that? They go, we will. And you're going, yep, that's really cool, but that doesn't pay bills. How do we actually get to that point? And let's pull it apart and think, well, how are we going to get that magic dollar per month increase that's going to happen? And we need to work through all the different options. So, that might be relying on your customers a bit more. It might be on your suppliers a bit more. It might be, okay, we're now at the stage where we need to start a relationship. And it might not be, Marcus might not say, I'm going to fund 100% of your invoices for the month. It might start off at 20%, because you need to build that relationship over time to the point where they say, okay, we now understand your business. We now understand how this works, and we can then start to go on the journey with you. So that way over time you can build things up. And I think that's probably a hard part for a lot of businesses, is they expect it's just going to be bang, someone's going to come in. But whether it's debt funding or an investor, someone has to understand your business and go along on the journey, because they are also investing with you. So making sure you really understand your numbers and work out, well, how is someone going to actually fund this?
I guess one of the other options from a cash flow perspective is, the classic one, to put your prices up.
Yeah.
If you are being successful and you find that people are buying your service, your product, and with maybe a minimal amount of marketing or minimal amount of sales, maybe you're too cheap.
Yeah.
And that simply putting a few dollars on a product somewhere or something, and then potentially looking at your cost base as well. Yeah. Can I buy some of these things cheaper or?
Well, again, that comes down to understanding intimately the numbers in your business, whether you can do that. Because you don't want to put it up too much and then no one buys it, or you get less sales and then you ended up like in a worse position. Yeah. But you can put it up like $1 and you might end up making another 10%, with the same amount of sales. So you've really got to understand, and I would say that as a key takeaway, really understand the numbers in your business and your customers, who you're selling to.
And your competitors as well.
Well, and your competitors, know your industry. It's really important to know your industry, know your product, but really know your business intimately and know the numbers within your business. So,
but I think you touched on a perfect point there. If you can't raise yours 5%, obviously there's a cap on what you can raise. But to me, it's about finding the right type of customers. So then, if you can't put your price up $1, then that says something quite concerning about your business. Is it not positioned correctly? Is it too competitive? Is this actually a warning sign this isn't the right industry or the right process to be chasing? So there's a lot of questions that start to come out of this, and it might be just feeling things out, a product at a time or a market at a time, just to try and test out, well, what is that limitation? Obviously, you don't want to do what a whole bunch of car parks in Brisbane City did and charge $100 for 2 hours and then realise no one comes into the city anymore. There is that finding out what that price elasticity is. It is important to sort of play that test, and if you get the right customers, you can make those returns, and it's
because they'll end up wanting your product.
Yes.
And as soon as they want your product, you're in the perfect position because then you can sort of start driving the market price because they'll come to you because they want you.
And there's lots of stories and lots of history with products that are pricing themselves, and pricing becomes part of the marketing. In fact, that the higher they price themselves, they actually find that demand increases because there is a perceived value that they didn't have before. I'm not suggesting everyone goes out there and puts their prices up, but that is a...
I mean, we can maybe tie a few threads together here. I'm sure most people are familiar with or have come across Jira, right? The project management software from Atlassian. They use pricing as a really powerful marketing tool. So giving Jira away for free or for $10 at one point to, small and early stage businesses. But then having a pricing model that meant that by the time you got hooked on the benefits you got, you really started to make a lot of money for Atlassian. So, clever pricing strategies are important. And then maybe the second thread we can tie in is that I hate using Jira, and most people I know don't like using it. But the thing is, it solves a really significant problem for every organisation I've ever been with who's used it. So yes, even though the software's ugly and a bit clunky, it solves our problem. It works really well at doing what it says it will. So yeah, it's not the most beautiful baby out there, but it does what it needs to, and so you will pay for it.
Yeah. That's
Last couple of questions for today. I did promise that I would ask Rob to explain what a convertible note is because as it seems to me to be, if you are going to get someone to invest in your business, it seems to me to be a kind of win-win for everybody. But just give everyone kind of the dummy's guide to what a convertible note is.
Okay, so if you've got a new startup business and you're perhaps pre-revenue or very early revenue, it's really difficult to actually judge how much your business is worth, right? Because because you're very much at the beginning of your trajectory, any type of modeling you do, like discount cash flow or whichever, looking at comparables in your industry, so much of that is really hand wavy based on how well you'll execute it, whether there's any other changes to the industry, how you continue to develop your product if you're really early. So it's really hard for investors to value it, and it's very hard for the startup founders to value it as well. So the idea behind a convertible note is basically you say, well, hang on, we're not quite sure how much your business is worth other than we think, you're onto something here. So let's push off the time at which we value your business until the later stage, when you've got a little bit more traction, when we see how you've progressed to date. So a convertible note, or more commonly, I guess these days, you use SAFE notes instead, which is Simple Agreement for Future Equity, I think is the acronym. Okay. It is a way of saying that the next time you do a raise or the next time this series of trigger conditions is met, we're going to value your business at that point, and then we're going to either apply a discount to the money we've put up, or we'll apply a cap. So an example would be that quite often, if, for instance, a business is valued at $1 million and you're putting $100,000 into it, then the post-raise value is $1.1 million. You'll say, well, I'm not actually sure about that $1 million value. So what we'll do is we'll wait until your Series A down the track, and we are not willing to accept more than a $1 million valuation for the money that we've put in at that time. But if it's less, then we'll take that, or conversely, you can have other instruments that apply a discount based on whatever valuation is established then. It gets complicated when you've got multiple rounds of convertible notes and SAFE notes, and you have to use tools to actually figure out how much you could potentially get, or vice versa. But I would recommend that if you're going to go down the venture track, what you want to do is have a clear way where both you and your investor can agree on the value of your business, and a convertible or a SAFE note is a way to do that. And I guess secondarily, I would highly encourage everybody not to issue preference shares to investors if you can at all avoid it.
Right. Explain what a preference share is.
A preference share is that investor gets paid back potentially at a multiple of what they put in before anybody else gets any money out.
Right.
So if an investor puts in, buys 10% of your business at a 2-to-1 preference, then they need to get back twice the money that they put in before anybody else gets a cent off the table. The reason why you should try and avoid, I guess, that kind of more esoteric end of issuing shares is that it makes your cap table much more complicated. It makes it harder to explain to future investors, and it makes it less likely that you'll walk out of the game. You want your investors to have some skin in the game too, to support you. The reason why investors in startups get potentially big returns is that they take a potentially big risk, right? So it may not always be possible to avoid that, and certainly some of the big VCs in Australia do insist on preference shares, but others don't. So you should be speaking to as many people as possible when doing a raise, and keeping it as simple as possible, which is where convertible notes really does come in.
And a question for each one of you: how do you value a business? If these guys have got a current trading business, it's making money, it's making profit, it's paying wages, how do you value it? Because everything I see in the marketplace, you can multiples of revenue and multiples of profit, and it could be anywhere from 3 to 20. You sometimes get the sense that there's numbers being plucked out of the air, and how do you see it, Marcus?
Well, generally we work on EBITDA,
Right.
So that's earning before interest, tax, depreciation, and amortization of a business. So then it depends on the industry too. So you're really looking, 2.5 to 3 would be pretty standard, I suppose, depending on, across most industries.
Yep.
Then you're looking at goodwill is another way that you can throw that into the mix of evaluation. Intellectual property, which would probably be equivalent to your goodwill from that sense, because it's an intangible asset. And that's, it does get a bit complicated to answer, but in layman's terms, I suppose, or to keep it sort of quite simple, you're looking at more what equity is in the business, long-term growth, what the industry you're in.
Yep.
And then that's sort of how you'd value it, I suppose.
Anything you want to add to that, Andrew?
Oh, to me, there's actually no clear path. So there's, as you say, there's a bunch of different mechanisms. Here is X plus X equals whatever. But to me, it's about what people's perception is of that value. So for me, it could be that your business own, DoseMe is the cog that I need as part of my entire chain. So I will pay overs to get that because it completes my chain. And so for me, that end value is significantly higher, and what I'm willing to pay is worth, significantly more, or there's an emotional attachment or whatever it might be. So to me, it's, depending on the industry at any given time, it could be that it's 15 times multiple now and it's 18, and that obviously makes a huge difference. So it's about timing in the market as well. So there's almost too many factors at play. And it could be that you're just not getting your product or your business in front of the right people at the right time to get what it's worth, and that's the hardest part.
Yeah, I agree. And DoseMe actually was the cog that solved an issue for our acquirer. Businesses are bought; they're not sold. So you need to have something that provides a benefit for the business that's acquiring you, right? But likewise, you can influence your valuation by adding competition into the mix. And if you're selling a later stage startup, you may have an M&A advisor working for you, and part of their role will be simply fostering that competition. In terms of valuing your business when you're going on the path forward, there are many different ways of doing it. EBITDA multiples is probably the most straightforward one, and you determine what the multiple is for your industry. You can do discount cash flow models as well, but of course, depending on your assumptions, you can make that turn out to whatever you would like it to be. Or you can simply look at comparable sale prices of similar businesses. And that's probably the most realistic way of determining what you could potentially sell your business for.
To me, I think that's the most crucial thing. Is like I see a lot of people just say blanket, it's 3 times EBITDA for every industry, and you just go, well, hang on. Go and speak to M&A advisor, because I had someone a client was interested, and I said, well, let's go and have a chat. I don't know what the latest market is for your particular industry. Let's go and source that information. And they found out for that particular niche that they're in, it's 16.3 is the current multiple. And I went, well, spend the money, get someone who knows the market, because that $5,000 you didn't want to pay has literally made you $80 million, it's probably worthwhile having that discussion and getting the experts involved. And that to me, if you're going to purchase a property, you get a valuation done. You may as well get people who have the expertise, who understand that market, to be able to provide you that advice.
So I think kind of summing some of those things up is that, whatever business you're in, whatever industry size, there should be a succession plan, an exit strategy, and all of those things need to focus around potentially a value in the business that you can sell. It's no more complicated than that. You guys are building an asset, whether it's a business or in the same way that you build a house, that you want to eventually sell it. So you want to create profit and value in it, and with a view that someone else, and this is the key as well, I think, it's all well and good building something, but if there is no market for it, to buy at the other end, presumably you guys, certainly for DoseMe, and I'm sure you guys see them as well, is that there are businesses that are built with a view that there is a clear goal, a clear person to buy in the future. I guess my last question I want to ask all three of you. These guys out here, they're looking at invoice factoring, taking on an investor, using their suppliers as whatever they want to do to generate some cash, to generate some investment within their business. What's the one red flag that you would potentially say to them that just keep an eye on that thing? I mean, you've mentioned the shared classes and things like that. Is there anything else that you sort of go, just keep an eye on that?
Yeah, there's so many places where you can trip up here. An investor who's not actually solidly supporting and on your team. Yeah. So your investors will likely become board members as well. So you actually want to be able to work with them. Yeah. If you can't, that will cause you many, many problems down the track. And the second, I guess, warning would be, if you're raising money, you are selling part of your business. It's not a mark of success. It is a mark of validation in that someone else has faith in you, but raising by itself isn't a mark of success. Some people get a little bit carried away there. So I guess they'd be the 2 points.
Yeah. For me, it's terrible to say it, but saying that I heard the other day was be more careful about who you get into business with than who you get into bed with. Because it can be a little bit of a stranger relationship and can be, more painful in the long run. So to me, I look at it, I see a number of parties who want to let's do a JV or let's invest together. And there's so many people who are terrible to say, but there's sharks, there's vultures, and there is a range of absolute scumbags in the universe. It's terrible to say, but they do, where they come along and say, at this point in time, you need X, so I'm going to take more of the business than it's worth, or I'll arrange these services for you, but they won't be clear exactly what it is they're offering, and they will take more of your business on an unfair basis. So to me, it is a relationship between one party and another party, and be clear exactly what that is involved. Some people just say, I will give you the money and I'll be a passive investor and you can provide reporting to me quarterly and I'm happy for you to continue on your journey. There's others who say, I want to be a part runner of the business, or I want to get involved in it, or there's a whole range of different problems that start to come up, and just be really clear about exactly what that relationship is, what the boundaries are around that dynamic. Are they coming into work full time? Are they part time? Are they coming on as an advisor? Just really get clarity around what that relationship is, and just be, generally it's that gut feel as to, obviously people are out to make money, but if you get the gut feel that someone's not in it for a mutual benefit for both parties early on, then you look at that and go, well, this is a flag. Let's pull out. It's better to have no money than the wrong person involved.
Yeah,
I agree.
If you all work together, you should have a better outcome for everyone involved than if one person tries to undermine you.
Yeah.
There are a lot of people who unfortunately are a little bit more short-sighted than that. So I couldn't agree more.
Yeah.
Marcus, final word from you?
I think getting back to those numbers, really understand your business, know it intimately. And I think if you are going to look for investors, understanding, again, back to that relationship. I've sort of been talking to someone recently, looking at their business, and they got an investor to come in. They want to remain controlling of that business, but now they've got, they've still got control, but they've got nowhere else to go because they can't draw on their business anymore because they've given it away. So make sure that you can either buy that back or not sell as much. Look for alternatives before you give too much of it away. So that would be my 2 points. I think back to the relationship bit, understanding who you're investing with, and if it doesn't work out, you can get out of it. You know, and then know your business so that you know it is your baby. So really understand it, so you can make those decisions clearly.
Just want to thank you guys for all your time. What we might do after this is, I'm sure everyone's going to hang around for about 5 minutes, 10 minutes. If you guys have got any questions, well, they'll all be here. We can, you can ask them then. But I'd just like to thank Mark, Sandra, and Rob for their time today, and appreciate it. Good luck with everyone's journey out there when it comes to cash. Thanks very much for your time today.
A pleasure.
Thank you.
Yeah.
Thank you.